Good afternoon and welcome everybody. This is quite weird because I can't see you, but I think there are about 24 or 5 of you on the call. So for those of you who don't know me, and I'm hoping that you mostly do, my name's Isabel Oswell and I head up business audiences at the British Library. And in November last year at our National Network Steering Group, I introduced the, I suppose, not concept, but responsible finance and the use of CDFIs or community development finance institutions to support people who are underrepresented or perhaps hard to reach to start up a business or grow their business through finance that they might not be able to access, for example, via a bank. We've had several discussions about this, and at our last steering group meeting, or rather penultimate steering group meeting back in February, we were delighted to have Peter Udale from Responsible Finance and Karen Davis from Purple Shoots talking about, or giving an introduction to, and here is Peter. Welcome, Peter, right on the queue. And there was widespread agreement that everybody across the national network would like to have a training session to understand this particular type of finance better, and also potentially to pilot working closely with CDFIs locally. So without further ado, I'm going to hand over to Theo, I think you like to be called, Hadjimichael, who's the Chief Exec of Responsible Finance. And we also have 2 guest speakers, Mike Trotter from Let's Do Business Group, and also Angie Preece from BCRS Business Loans. And then after they've spoken, we will open up for Q&A. So over to you, Theo.
Thanks, Isabel. Hello, everyone. I'm just going to get my screen shared, but while I do that, I'll just introduce myself. I'm Theodora Hadjimichael. I'm the Chief Executive of Responsible Finance. Let's see, I just want to, can you all see that? If you could maybe put in the chat that you can see it full screen. But yeah, so I'm Theodora Hadjimichael, Chief Executive of Responsible Finance. We're the industry association for community development finance institutions, or CDFIs, in the UK. And we're very excited to be here today talking to you about more about CDFIs, and we're really excited about the potential to partner. And we hope that this presentation can start to kick off some more local conversations between CDFIs and libraries that can help businesses get access to finance. Okay, let's see if I can, okay, here we go. So I'm going to give you a quick overview of the CDFI sector. I hope it's not too much of a repeat of what you've heard before. And then, like Isabel said, Mike and Angie will talk in a lot more detail about their specific products and processes. So the CDFI sector is a group of a network of not-for-profit lenders that lend into market gaps. We have about 45 members that lend about £250 million a year to more than 5,000 small businesses, over 600 social enterprises, and more than 40,000 consumers. And CDFIs really exist to build wealth in their communities, and they do that by helping new businesses start up, helping existing businesses grow and create employment, or helping consumers avoid, save a lot in terms of interest repayments to really high cost credit, high cost lenders like payday lenders. And I think what we see is that CDFI, not a lot of people know about CDFIs actually, and even I think a lot of people don't understand why CDFIs need to exist, because the UK is seen as this global banking and fintech center. But the reality is, as I'm sure all of you are really aware of from your work with startups and small businesses, is that a lot of viable business propositions really struggle to access the finance they need from the mainstream. And that's largely because mainstream lenders, they have a lot of regulation around them. They are also shareholder driven, which means that they have to lend at a really large scale to very profitable businesses. And they mostly do that by automated lending or algorithm-based lending. And that means that viable businesses, just very fundamentally good businesses, do fall through the cracks. And I've laid out a number of reasons here, which I'm sure you'll be familiar with, as to why a lot of businesses don't tick some of the boxes for mainstream loans. And the CDFI sector really exists to fill these gaps. And they do that because they're not-for-profit lenders, and they're not shareholder-driven lenders, so they can afford to take a different approach, spend more time sort of really understanding the reasons behind why the bank said no, and seeing if they can turn that into a yes. And I think what's very unique, what we see is very unique about CDFIs in the wider lending landscape, is that they very much look at future viability and forward plans, rather than just focusing on past history and past performance. So they look at strength of assumptions in the plan and forecast, the strength of the management team, and so on. I know Angie and Mike will go into this in a lot more detail. So I wanted to also give you a very high-level overview of the types of products that CDFIs provide. And now I'm aware that it does vary from CDFI to CDFI in terms of the products on offer, the pricing, and the terms. But I wanted to give you an overview of the average, what the average products on offer look like at CDFIs. And that's, we have sort of three main products, and that's startup loans, SME loans to established businesses, and social enterprise loans. And I think what you'll find from working with the CDFI more closely is that they're actually their products are actually very flexible and tailored to a business's circumstances and needs. And I think that's especially true when and if a business encounters difficulty repaying. CDFIs are able to be very responsive and tailored in their approach. I wanted to also touch on CDFI interest rates for a little bit, because when we spoke to Isabel, she thought this is a topic that there might be some questions around. So I wanted to add some clarity around what CDFIs charge. So for, as you might have seen on the previous slide, CDFIs for startup loans, they typically charge 6%, and that's because they're lending under the government's startup loan scheme, which is capped at 6%. For SME loans to established businesses, the average interest rate, again, this varies by CDFI to CDFI, but the average interest rate is about 12%. And we do hear sometimes that people think that's high compared to other lenders on the market. And I did do a quick Google search before this and saw, Funding Circle has ads for business loans from 4% and up. And similarly, NatWest and some of the other banks had rates around that. And so I can see that compared to that, 12% might seem high. So to add a bit of clarity about why, I suppose the first thing is that we're serving a completely different segment of the market. So then those ads are targeted ads. So our customers, 90% of the businesses that we lend to have already been declined by another lender or a bank. But so it's a higher risk segment of the market. But we know that the CDFI approach is very effective. So 85 to 90% of our customers who've already been told no by another lender, go on to fully repay their loan, succeed and grow and thrive. And that very effective approach is based on a relationship-based model and a higher touch approach. And it's very effective, but it is more expensive to assess and deliver and manage a loan in that way than it is through an algorithm-based approach, which is what most commercial lenders use and why they're able to have their costs so low. Another sort of aspect about lending into a higher risk segment of the market is that our investors price for that risk as well. So CDFIs, they're not like banks in that they don't take deposits. So we have to raise all of our capital to on-lend externally. So our investors price for that risk. So our investors charge for the capital that's CDFIs on lend, our investors charge us, I'd say 3-4 times what banks and fintech lenders are able to access their capital at to lend into a lower risk segment of the market. So those are some of the sort of key aspects behind what CDFIs charge and a bit more color as to why. I think the sort of message is, rest assured CDFIs are not charging 12%. They don't have shareholders, so they're not trying to make a profit and distribute profits off of their lending. They're charging what it costs, the reality of what it costs to deliver a loan into a higher risk market in a very effective way that gets good outcomes for the businesses. And we see that in terms of our success rate and customer satisfaction. So I hope that adds a bit more clarity to the interest rates point, but happy to cover any more questions. And I just wanted to finish off with a customer quote, which we really love because it shows the why customers love working with us and the value that working with the CDFI has on the businesses that they work with and they lend to, and what really makes CDFIs unique in sort of a sea of, I think, what are pretty faceless online lenders at the moment. And I think, I imagine all of you, you operate in a relationship-based approach. So you really see the value that has in terms of, even the softer side of starting a business and growing a business in terms of how it builds confidence for that business to really take off and grow. So I hope that's been a useful introduction to you on what the CDFI sector is and how it approaches business lending. Here's a couple of links to our website, and then we also have a directory of CDFIs by location at our website, findingfinance.org.uk. So it's an easy way to go and find one near you. So thank you again for joining today, and I hope you found this useful. And I'll now pass over to Mike, and I think I'm going to share your slides as well. So bear with me while I get those up. Is that all right? Can everyone?
Excellent. Yeah, it's brilliant. Thanks, Theo. Afternoon, everyone. My name is Mike Trotter. I head up the lending team at Let's Do Business Group. Just a little bit of background about us. We are based down on the south coast in Hastings, as well as providing a range of business finance. We also provide business advice and support through a number of different schemes across the southeast. We also manage inward investment for the county of East Sussex, and we also manage the local Chamber of Commerce down in Hastings and St Leonards. As an organisation, we've been in existence for in excess of sort of 30 years, originating out of what used to be called enterprise agencies. So I'm focusing on sort of finance today, and I'm going to specifically focus on the startup market, and then Angie is going to discuss in more details in terms of what's on offer for more sort of established businesses. We provide a range of sort of different sort of finance to sort of businesses. So I'm going to focus on the startup loan scheme. So this is a government-backed scheme. It's actually been in existence since 2012, and as an organisation, we've been involved in it since its outset. In that time, it's backed in excess of 75,000 businesses and lent in excess of £625 million. So it focuses on startup and newly traded businesses, and we are one of 21 official delivery partners delivering the scheme on behalf of the Startup Loan Company and British Business Bank across the country. In terms of a few sort of details, it is government backed, but that doesn't mean that it is a guaranteed loan. Unlike many options of finance for businesses, this is actually a personal loan. And that means that the individual or individuals applying for it will always remain liable for any amount outstanding, irrespective of whether the business is successful or not. Applicants can borrow between £500 up to a maximum of £25,000. The average loan size for the scheme is just under £10,000. Applicants can repay between sort of 12 and 60 months. The interest rate, I think Theo alluded to earlier, it is fixed at 6% per annum, and there are no associated fees with the scheme. So there's no arrangement fee, there's no fees for early repayment or lump sum reductions. Part and parcel of the scheme is not only just providing finance, but it's providing with pre-loan support and also post-loan support through a mentoring scheme. Next slide, please. Like any loan facility, there are certain sort of eligibility sort of criteria. So you must be ready to launch your business or have a business that has been trading for up to 2 years. You have to believe that you are likely to be refused for a bank loan, which is the sort of traditional route of finance, but we don't insist on any documentary evidence in respect of that. You must also have a viable business proposition, and in terms of sort of credit criteria, if you are sort of subject to either a bankruptcy order or an insolvency order, you would not be eligible to apply. You must be aged 18 or older. You need to reside in the UK, and you need to have the right to live and work within the UK. You can only have one loan for one business, but that can be a first loan and a second loan. So if you've already had a sort of startup loan for one particular business and you're looking to start another business, unfortunately, you would not be eligible to apply under the scheme. There's certain business types and loan purposes which will not be sort of eligible. A sort of example is if it's sort of involved in, say, ammunition or gambling, then it would not be sort of eligible. In terms of loan purpose, we cannot repay any existing debt, whether that's personal or business debt, and we can't fund any qualifications that are mandatory to be able to start the business. You also need to pass the credit checks as well. In terms of sort of the core things we look at in terms of the actual business proposal, there are sort of 3 sort of key documents. There's the business plan, there's a cash flow forecast, and there's a personal survival plan. The business plan, it doesn't have to be like War and Peace. It can be as brief as you need it to be, as long as it sort of fits the business model. Some key things which we look for is in terms of making sure, and it might sound obvious, what your business idea, making clear what the business is looking to actually do, what experience you have relevant to that business, what you're looking to achieve. Have you got any objections? What is the ultimate mission for your business? What market research, market analysis have you done to show that there is a demand for your service or for your product? And have you looked at your competitors? How do you compare to your competitors? Do you have a USP which will differentiate your particular business from those already doing similar out there? Have you really identified who your customers are going to be? You know, who is your market and how do you reach them in terms of your marketing strategy? Your pricing, that's important. Have you worked out how much you're going to charge for your services? How does that compare to your peers? And in terms of your operations, do you need premises? Do you need an office? Can you operate from home? Do you have the right licenses, regulations in place to be able to do that? And that all sort of fits into transferring your words into some numbers in terms of the cash flow, which is another important document. So a cash flow forecast. If I'm honest, for the majority of people we work with, this is where most of them sort of really struggle, because it's the first time they've started a business and it's a document which they're not sort of familiar with. All we require is a 12-month cash flow, which breaks down on a month-by-month basis, projected income and expenditure lines. Other things that it should show is in terms of, it shows how much the individual needs to start their business, whether apart from the loan they're applying for, do they have access to any other funds? That could be a grant, it could be savings, it could be another investor, and they break down how those loan funds are actually sort of required. It is a working document. It doesn't mean that it's the sort of finished article, because once an individual is up and running, very rarely in terms of trading will it sort of mirror their forecast. But it can be used to show in terms of how close they are to that forecast, whether they need to make any adjustments, etc. Personal survival budgets. This is important for this scheme because it is a personal loan. And what we're looking at here is in terms of the affordability of the individual applying. So we're looking at what income and expenditure they have outside of the business. And it shows a couple of things: how reliant they may be on the business for income, or they may not be sort of reliant at all. We do get an awful lot of people who will start a business alongside employment and therefore not be reliant on the business for income from sort of day one. Okay, in terms of the process, it's an automated process, and the portal is run by the sort of startup loan side, and there's two sides to it. There's the customer side, and then there's the delivery partner side to it. So the applicant will create an online account, go through a few sort of initial eligibility questions. Assuming that they go through all of those successfully, then they'll authorize a personal credit check to be undertaken to assess whether they meet the scheme profile. If unfortunately they don't, the applicant will be declined at that stage. If the applicant is successful, they'll be asked to complete an application which sort of focuses on the business, and they'll be asked to upload the necessary sort of documents. In terms of sort of business plan, the cash flow, the personal survival plan, these templates are all readily available on the Startup Loan website, and they can be downloaded alongside guidance notes to help the applicant complete them. Once they've done that, they are allocated to a delivery partner, such as Let's Do Business Group. Normally it is done on a sort of geographic basis, but the applicant does have the option to request a specific partner because they may already have an existing relationship with that company. So once an applicant is allocated to us, we will send out an introductory email introducing ourselves, confirming that we'll be working with the applicant, hopefully to get a successful outcome, and we'll outline what happens next. So the initial stage is like a sort of triage stage where we will go through with the applicant to make sure that they have provided all the necessary documents, undertake additional eligibility checks, and then we'll sort of provide sort of feedback and support on the business plan, the forecast, and the budget. Where necessary, there's a lot of additional resources on the Startup Loan website, and we can signpost them to there if necessary. Once we have all the documentation, then we'll pass the application across to one of our experienced business managers, who will then start the formal assessment. Next slide. So in terms of the assessment, key criteria: business viability. Does the business appear viable or not? Does the applicant have the relevant knowledge, skills, and/or qualifications to be able to deliver a successful business? Is there good sort of personal affordability? Or if not, does the applicant have a good backup plan to repay the loan if the business does not trade? Looking at the credit profile, do they have a strong credit profile? Is it a weaker credit profile? In the assessment stage, all applications will actually be looked at by 2 experienced managers. So it doesn't mean that just because if you like, for the initial assessment, the manager is not keen on it, it doesn't mean that when it goes to second assessment, it'll automatically be declined, because decisions can change. So number of possible outcomes. The applicant's loan is approved at the amount that they request. It may be approved at a lower amount where it is deemed there is not sort of justification to lend at the level requested. We may provide a tranche loan. So, for example, somebody may request 25,000, and it's deemed that maybe they only need 20,000 initially, which will be drawn, and then a second tranche is made available and then is normally drawn down 3 to 6 months later. Or unfortunately, the loan is declined. All declined applicants are signposted to the sort of government business support helpline for guidance on any other sort of possible schemes, and/or if it's in sort of local area, we'll advise them if there are any sort of particular sort of local schemes that may be an option for them. To just run through the most common reasons that we have to decline a loan. It's poor personal affordability, and it's where some credit issues come to light which may have not been declared on their application or may not have come to light through the credit check. The business model is just not viable or realistic, and often coincides with the applicant failing to provide any sort of additional information to support the proposal. Poor or incomplete business plans, We do get business plans which just have one line. We do get sort of forecasts which are just totally blank, and that sort of prevents us undertaking a full assessment. The applicant does not have the relevant qualifications and or experience to deliver the business. For example, we have had individuals wanted to set up as a driving instructor, and they only have a provisional license, so they haven't even sort of passed their driving test. And lastly, there's no acceptable backup plan provided. So if in the event the business fails, there is no backup plan there to support their ability to be able to sort of repay the loan. And in those circumstances, as a responsible lender, we would not wish to lend. Those are my contact details. I think Theo's going to share my sort of presentation out. So if anybody's got any sort of questions after the event, they're more than welcome to email us. Okay, thank you. I'm now going to pass over to Angie.
Good afternoon, everybody. Angie here from BCRS Business Loans. I hope you're all well today. I'm going to give you a little bit more of sort of a general overview of CDFIs, as in those that sit in the sector that I'm in, or the area that I'm in, really. What I'm going to go through in a moment is a little bit about why businesses might need funding, where they can get it, and ultimately the best chance of securing funds. So just to start, a little bit about BCRS. We are a lender, a CDFI based in Wolverhampton. There's 5 of us BDMs out on the road, and I'm lucky enough to be living in Worcester. So I cover Worcestershire, Herefordshire and Gloucestershire, as well as most of the rest of the Midlands. So what I would urge you to do is, if you're not in the Midlands area, then I would suggest you to contact your local CDFI, and I think Theo put out a link for that. Just so that you can understand a little bit more about them and what they do. Connect with them, try and have a session with them, and at the end of this, if anybody would like some more specific info, hopefully I'll be working with Worcester and some of the local libraries as well. So a little bit about BCRS. We are, as I say, based in Wolverhampton. We are not in the startup market. Not that we don't love startups, of course we do, but that's best to leave to people like Mike and Let's Do Business. We're really more involved with the growth aspect of the CDFI lending. We've been involved very heavily with the C-bills lending, which has been interesting and exhausting for quite some time now, and now the recovery loan scheme is sort of the main scheme that we're focusing on at the moment, although we do have other schemes as well. We lend from between 10,000 to 150,000 maximum, over a maximum of 5 years, and our rates generally are anything between, on an unsecured loan, sort of 12 to 14%, and maybe if somebody's offering security, it might be as low as 8%. But that's really where we sit in the market, which is about what Theo was telling you a little while ago, really. And our rate for borrowing is, our fee for borrowing is 3 to 4%. There's no redemption fees on any of our loans. So as Theo explained, this is about lending when the banks can't lend. So the idea behind this is, you know, your customer might have gone to the bank, they can't borrow, they come to us or somebody similar. We're not going to keep them forever. That's not the idea of our lending. We keep them for a maximum of 5 years, and then hopefully they'll either have repaid or they can refinance to move back to their banks, maybe at a lower, hopefully at a lower rate of interest. Quite interesting. One thing that Theo picked up on was at the beginning was about rates and about rates that people are offering, and you commented on Funding Circle actually, Theo. And interestingly, I was talking to somebody today who's paying a 22% interest rate with Funding Circle. So the other thing to be aware of is that a lot of these rates that are out there are very much headline rates as well. So absolutely they start at 4%, but they also lend at 22%. And it's all risk-based. It's all risk-based for all those reasons that Theo told you about earlier. So when a customer goes to the bank and they can't get lending, they can feel pretty rejected, as you know, as I'm sure you're aware. And that's really where we step in. So you, as another avenue for people to be able to access us, CDFIs, it's really, really, really important that you guys understand where we fit in the market and how we can help. So as I said, I really urge you to either contact me and I'll do some more training, or speak to your local CDFI. What we do is term loans. It's pretty simple. It's a bit like your personal loan. We lend money over a certain period of time and the customer pays it back, so they know exactly what they're borrowing. And we're often called what's called a storybook lender. So again, the difference between us and an algorithm lender, like somebody like Funding Circle, is that everything is done personably, nothing is uploaded. So all the forms are completed, and then somebody like myself or one of my colleagues will have a look at it, have a real good think about the business, have an appointment, discuss the business, the trials and tribulations, what's happened, the story behind the business, and then we can make an informed decision on how we can support that business, rather than tapping details into a computer and seeing if the computer says yes or no. That's really, really important. In fact, looking at the whole scenario. Okay, so briefly, why would a business need funding? We've just discussed startups at length. It's not where we sit in the market, so please go over to Mike for that, really. Business growth and employment. Companies can't survive, companies can't grow without having the people behind them. Stock purchase, funding contract, really, really important, especially at the moment. If we're thinking about COVID, these things are really coming to the front because people haven't got the cash behind them to be able to fund those new contracts, to be able to get new customers. So it's a constant cycle. Cash flow and working capital. People often, when you ask what they want the money for, sometimes they find it hard to articulate, but often don't want to say it's just for cash flow. That's absolutely fine. There's no problem at all. Working capital and cash flow, again, thinking about coming through COVID, is probably the most important thing for a business. And certainly at the moment, the most important things that we're being asked for now. Purchasing new premises, there's some real bargains out there at the moment, sadly, because some businesses aren't around. But similarly, there's some presentation's gone. There's some really good bargains out there at the moment. So there's a lot of people looking to purchase new premises. And protecting against late payments and bad debts. Lenders will really want to know about customers. They'll really want to know about your trading cycle, who your customers are, especially again coming out of COVID. Things are really, really tough at the moment. So have a good think about that. And do you need funds available? Does your customer need funds available to secure against late payments and bad debts? So where's your customer going to go to get the funding, or what type of funding should they be getting? And I think this is, I'm sure we've got people on here with lots and lots of experience, and we've got other people that are sort of new to the lending scenario. So I'm not meaning to teach anybody to suck eggs, but I was asked to really touch on the areas that businesses can go to and the types of the types of lending that businesses can get, really. So we've got our traditional bank, we've got the overdrafts and the loans from the bank. Overdrafts and loans are very, very, very different, and it's really important that, again, even just thinking about that, the customer gets the right facility. If you want to go and buy a piece of equipment, getting an overdraft to do that is not going to be ideal, because, well, it's going to be less than ideal, because you'll have a 10,000 overdraft, 20,000 overdraft, whatever that is, and day one you'll spend that money and you'll be sat with a deficit on your bank account, and that's going to become really expensive, because you're not going to be able to pay that 20,000 back until you sell that piece of equipment or make an extra £20,000 worth of profit that you're not going to be requiring. It's really not good. So making sure you've got the right facility for the right product is really, really important. So alternative lenders are us, that's where we fit in. And this is a really growing market, as you could tell from what Theo was saying. You know, people don't fall out of the banks. Where do they go? Panic sets in, and that's really where we step in. Some peer-to-peer lending, I'm sure you've heard of that as internet matched lenders and borrowers. Grant funding, everybody loves the idea of grant funding, which is great because it's free money, but trying to get grant funding can be really, really difficult. And we find that a lot of people that have come to us have failed in grant funding. The reason it can be difficult is that it's really difficult to qualify, and you absolutely need to know that you've got the right people filling the right forms out, because if you do something wrong on those forms, then the likelihood is you'll be declined immediately. So if you're going to do some grant funding, or if customers do some grant funding, make sure they've got knowledgeable people to support them with that. Thinking about equity funding, we all know about crowdfunding, I'm sure. It's an internet platform, small amounts of money are put in by lots and lots of people, and that's usually successful if you've got a fun product or things that people really get excited about. That can be really good, but others can similarly fail. Angel investors, they're individuals with some money in their back pocket, but it's trying to find the right one. So that's pretty difficult too. I'm giving you a bit of an overview here, as you can tell. Venture capital, this is generally people with lots of experience and proven track records, and they're really going to focus on strategy and probably going to be the bigger businesses rather than startups. Dragon's Den, we're all familiar with that from the TV, where you stand in front of a panel and God, I could never do it, and try and pitch your wares. Pretty horrendous stuff. You might have heard of invoice financing or factoring, as it was known, which is a good form of cash flow borrowing. It's brilliant, and it's great for startup businesses and growing businesses because it's funded by the debt book, and that means that it can grow with the business. The difficulty behind it is it can be quite difficult to get out of, quite difficult. Asset-based lending. We've got HP and lease. So HP is when you own the product, lease is where you lease something for the life of the product and generally hand that back. I guess the last two are really interesting. So payday lenders and loan sharks, and these are the guys that we really, really want to stop, all the guys that come to you to go into, and that's why, again, it's really important to be speaking to people like us. Payday lenders and loan sharks, we see people come to us and they're in such a pickle by the time they often come to us. They've got lots and lots of debt. So if you can support them and give them advice and try and either help them out of that or not get them in the first place, that's really important. Own or family funding, I'm sure Mike would agree with this. This is often where startups have to start, or people who can't tick all of the other boxes. Don't get people to poo-poo it. It's really cheap money, often, if you can get your family to support you. And it's a good way that many, many big businesses have started up. That's just a little bit of an overview of different types of borrowing. Okay, so I just want to touch on when you're going to be coming into looking to a CDFI for growth, the sort of stuff that you're going to need. And I know Mike's touched on this already, so I'm not going to go into great detail, except to say that we would expect that these guys, by the time that people get to us, they've got a little bit more experience. They're not a startup. They should be able to give over a really good understanding of their business. And I would say that's probably the one thing to try and instill in customers when you're speaking to them, is that they need to come across as they're knowledgeable, that they know their business. They shouldn't be making suggestions on what they might like in their cash flow or in their business plan. They should be saying exactly what they want and why they want it. So it should be a little bit more firm. Pretty standard stuff. Application form. It sounds really simple, but the amount of half-completed application forms we get is ridiculous. And you know, as a lender, when you see somebody who can't be bothered to fill in basic forms, it really does turn you off wanting to lend to them straight away. So I think, again, just try and get that point across to people. Business plans aren't so important in our world, world of businesses that have been going a little bit longer. But if somebody's got one and it's to the point and really good bullet points, then we're not going to turn that away. That would be really good. Again, statements of assets and liabilities, which really go in conjunction with a credit search. Make sure they tally. These customers are signing on the application form and on the statements of assets to say that the information is true and correct. And again, it's the same with all lenders. If somebody hasn't disclosed something and they signed to say it's true and correct, and we're going to find out that they've got defaults or CCJs or bankruptcies or whatever it may be, then the chances are that neither us or many other lenders are going to want to lend to them. So that's really important. The financials really are split into three sections. So we've got historic financial information, which is your trading accounts, current information, which is your management information or management accounts to bring us up to date from the last set of accounts. And then you've got your cash flow forecast, which is your future. So you've got historic, current and future financial information. At the moment, I would say, bearing in mind that most of what we're doing is on the recovery loan scheme, the most important thing at the moment is some really, really robust cash flow forecasts. And I mean really robust. So trying to get customers to borrowers to speak to their accountants and get their accountants involved and support them is, again, really important. I would dread to think the amount of times that we get sort of half completed cash flow forecasts or a suggestion of how much they like to borrow. And unfortunately, I can't guess what people might need to run their business. We also require assumptions. I think it's really important if people can put assumptions with their cash flow as to why they feel that their turnover is going to increase by 3 million next year, or why their cost of sales is going to reduce by 20%, or why they need the new machine. That's also really important. As I say, credit search is really important for us. And just on that note, as Mike touched on, what we do find is that people who've got a lot of personal credit issues statistically often don't pay their business debt. So that's really important even to us. I know we're what we call second tier, but it's still really important to us that people personally pay their personal debt, because if they don't pay that, then, like I say, the chance of them paying their business debt long term is pretty slim. Okay, so hopefully that's given you a bit of an overview on what you need to provide, a little bit about CDFIs in general and why they might need funding. I guess the only thing just to finish on is just to say you can't help everybody. So whilst we're making it sound great as if we want to help everyone in the world, we sort of do, but you also can't help everybody. So don't beat yourself up if ultimately, you know, they don't fit. My other piece of advice would be make some good contacts yourself, because more people like myself and Mike that you know, the more people you'll be able to speak to. And as the world's opening up, get out there and network. Get out there and network in your local area. Meet people, meet bank managers, meet people like us, meet business support, other business support services as well. That's it for me. So thank you for your time.
Thanks so much, Angie and Mike. That was really enlightening. It's a bit of a whistle-stop tour and a lot to take in, but it is a missing piece of our armoury, really, in the IPC National Network. And I also wanted to welcome our SME champions from startups and online libraries. But I'm sure that some of our participants have got some questions. So can I ask a question about both Mike and Angie? I don't think you are necessarily aware that we had a business and IP centre network before we spoke, before we prepared for this presentation today or event. So did you know there were business and IP centres around the country, and now one in Worcester, for example, and one about to opening very soon in Brighton? And seems to me that we could help people to provide a lot of the information that your clients need in terms of market size and trends and competitive landscape and so on.
Yeah, I was embarrassed, as you know, when we spoke some time ago, to say that I didn't have a clue what you guys did in the libraries. I had no idea, and we've got this beautiful gold building in Worcester that I walk past and don't particularly visit, and as I say, didn't know what was inside. So for me, this is really exciting. This is great to think that, you know, we can connect with you guys all over the country, as and other CDFIs, and it's just another way of getting it out there. Brilliant. We're looking forward to it.
Absolutely, and sorry, I now have Alex from BIPC Worcestershire wanting to ask a question.
Yes, my name is Alexander and I work for the BIPC Worcestershire team. We formally launched earlier this month, so it's all a bit new to most of us. I was just wondering about Sharia finance, because the BIPC network does have targets for engaging with ethnic minorities, and I'm wondering how that factors into responsible finance.
So CDFIs generally as a network punch above their weight in terms of reaching underserved groups. So I think the latest stats we've seen is that there's, I think, 5% of the business population is led by a minority, ethnic minority, and CDFIs lend 10% of their loans are to minority-owned businesses, and similarly, I think women-owned businesses account for something like maybe it's 10% of, or sorry, I think, yeah, maybe it's 10% of the business population, but CDFI, 26% of CDFI loans are to women-owned businesses. So CDFIs generally punch above their weight. So I think even without specific Sharia products, we do have a couple of specialist lenders within the network that provide Sharia finance through the startup loans scheme. So that's and we can connect you specifically with them if that's something you're interested in. But I think as a whole, the CDFIs are very good at reaching underserved and underrepresented groups.
Okay, thank you.
Thanks, Thea. And we've got we've got two further questions, and I was just wondering whether our panelists, everyone wants to stay for a further 5 minutes because we are running a little bit over. So Geraldine now.
I have a couple of questions actually. The first one is, my husband and I actually have an investment in a company where the founder and managing director had been in prison. So he was declined funding from everywhere. This business is now getting on for, I think, about £2 million turnover and doing really, really well. Even after year 2 with a good set of results, he was still getting declined. And I just wondered if the panelists had any views or information about people with convictions, whether that was just an automatic barrier to any funding.
Should I start on the startup loan scheme?
Yeah, carry on.
Yeah, I would say any individual who has had a criminal conviction in the past or unspent conviction are eligible to apply for the startup loan scheme, providing they meet the other criteria, and as long as in terms of what the business model is, that they are able to freely run their business without there being any sort of restrictions which may prohibit that.
Yeah, oh, great, thank you.
Sorry, just from our point of view, very much the same. It's about again being a storybook lender for us. So it's about understanding what happened, why it happened, what the circumstances were, etc. So, you know, if you think on it from a lender's point of view, they want to try and mitigate bad things happening. So it's about just understanding what's happened before. So yeah, you know, obviously have to meet the other criteria as well. But yes, be really happy to look at that.
That's great, thank you. I
think we may have come to a close, which means that we can actually finish on time. But I found that incredibly useful and informative, and I now know a lot more about obviously startup loans and CDFIs than I did an hour ago, and also the other options available. So I think it's now for us to, because we had a lot of the BIPCs around the country who were very keen to work in on a pilot with local CDFIs. So I think that's the next step, really, now that we have a better understanding of what CDFIs and startup loans can offer. I also want to, actually, I had another question. Do all enterprise agencies offer startup loans? This is one for Mike.
No, not all of them, no.
Okay, because clearly there are enterprise agencies all over the country, and I just wondered whether they were all offering loans. But a huge thank you to Angie, Mike, Theo, and we will definitely get this off the ground now, because I think we will have a much better understanding of what's available and what the criteria are, and what the other options are as well, and why CDFIs are important. And as you know, we are very strong on supporting people from diverse and disadvantaged backgrounds. So incredibly useful. Dave, I don't know if you've got anything to add. I don't want to put you on the spot.
Nothing to add, just that if we can get hold of the list of CDFIs in each area, we'll circulate that round to the whole network. Yeah, and try and start to make some of those introductions and encourage everyone who has a CDFI nearby to get in touch with them and yeah, kick off the conversation with them locally.
Just say that certainly from my point of view, if anybody is Midlands based and wants to contact me direct to do any further training or support, really happy to do so. That would be great. Great to speak to anybody.
Thanks, Angie. Well, you know that we have one in Worcester, Worcestershire, another at Birmingham, and it depends whether or not Nottingham fits your criteria. Anyway, that's brilliant. Thank you so much. And I'm sure they'll take you up on that. Okay, well, many thanks everybody for joining us. And sorry that I couldn't see all your faces, but anyway, I think it's really been a useful and productive afternoon or hour. And look forward to working with you more closely in the future, Theo, Angie, and Mike. And thanks for coming, Peter.
Okay.
Thank you.
Okay.
Thanks, everyone.
Bye.
Bye.
Bye.